welcome to Street Check, the best podcast in the history of Cabot Wealth Network, which has been in business since 1970, delivering investment insights, research, ideas, stock picks for more than 50 years. I'm Chris Preston, editor-in-chief.
And I'm Brad Simmerman, the web editor, chief analyst of Cabot Wealth Daily. We're going to do a bite-sized podcast this week, leave you plenty of room for turkey and pumpkin pie. Chris and I are going to forego our normal format and give you a brief podcast this week ahead of the holiday weekend. And we're going to talk about the stocks that we like to add to your Black Friday shopping list. Holiday season here. Black Friday shopping has commenced. Thanksgiving tomorrow. Chris, any particular plans?
Yeah, we're hosting my wife's family, her parents, brother, and two teenage kids. Yeah, not too bad. I mean, we are hosting, but at least we're not having to travel. How about you?
Hosting my wife's parents as well. My family's in Cali and possibly Vegas, and some of them are in Chicago for the holidays. What is your turkey prep method?
We use what's called Bell's seasoning. It's like put it on the whole turkey. It's like it looks like Old Bay, but it doesn't have the bite of Old Bay. Maybe the flavor is a little bit mild, but put butter in there and olive oil and
Brining?
Away we go. Oh yeah, brining. Yeah. How about you?
Dry brine for a couple of days in the fridge and then oven roast. Wow. Found a good New York Times recipe a few years back, and it's like one of the stereotypical golden brown, excellent turkey. I like the smoking, but skin tends to get tough, so that's a tough one.
Yeah, they have turkeys in Arizona. They don't.
We do. Yeah.
Are they road runners disguised as turkeys for Thanksgiving?
No, we actually have a native turkey population. It's really, really small. When I was still in Prescott, we had one instance in which a bird actually came into our backyard. But it's not like it is back east, where it's like you can't drive without accidentally hitting one with your car, or at least that's the case at my in-laws' place in Maine.
Yeah. I went for a run a few weeks ago and heard almost seemed fake, like someone was blasting turkey gobble noises from their house, but there's real turkeys around the corner, and they either chased me or ran with me for like quarter of a mile. At first I was a little sped up, but then I realized I think they were just getting in some calisthenics. But yeah,
I mean, revenge
happens tomorrow. What?
I was gonna say, you're a shotgun away from a free Thanksgiving dinner, so
I know. Yeah, well, tough thing to carry while you're running. Okay, so let's get to the stocks. So yeah, these are, I don't know how seriously you took your three. We'll do three each. I wanted to look for good stocks with good charts, but also just stocks to sort of get in the holiday spirit, like as you mentioned, for your Black Friday shopping list. I'll let you kick off with your first pick.
All right, I'm gonna start off. I was looking at game systems. I've got a teenage boy. I play video games periodically. The Microsoft, the Nvidias of the world, they're a little bit too overpriced. So I was looking at accessories, things like that on the Walmart Black Friday cover page. Came across a lot of Samsung and JBL, which is a consumer electronics product that's manufactured by Samsung. The problem with Samsung is you can't buy it in the US. Right, it's listed on the South Korean exchange, and it's a really high barrier to entry if you're a US investor that wants to try and trade there. So I identified two ETFs that give you a fair amount of exposure to Samsung. One is the EWY, which is a Korean-focused ETF. It is 24% Samsung. It's market cap weighted, so they pare that position down periodically. But if you wanted to just go onto your broker's website and buy Samsung, this is as close as you can get. EWY, it's 24% in Samsung. The other ETF that I looked at, which gives you some broader exposure, is EEM. It's an emerging markets ETF. It's 4% Samsung, so barely any exposure there. But the other top three positions are TSMC, which is 6% of the fund's assets, and Tencent, which is 4%. So it's giving you exposure to Taiwan Semi, Tencent, which owns ByteDance, which owns Snapchat, right?
Yep.
So it's giving you sort of a broad exposure to youth trends. Top 15% of the portfolios in there. Also pays a 2.4% dividend distribution. Neither one has a screaming buy of a chart, but I mean, after a 2-year stealth bear market, not a ton of stuff out there does. But Samsung, reliable consumer electronics play. I like it. I own Samsung products, EWY, EEM, two ways to get in there.
Nice. Very good. So you're adding a bonus, essentially right off the bat. Okay. I will go. I'm going to open with Ross Stores. ROST is the ticker symbol. You know, we've often been big on dollar store stocks here at Cabot. Mike Santola, those are a favorite of his. He's recommended a number of them in the past, and this is one I think has been off and on his list for a while. But you know, it sort of disappeared in 2020 and 2021 when any retail stores with a huge brick and mortar presence took it on the chin, but they're back now. Sales hit a record high near 19 billion at the end of, in 2021, they bounced back to a record high of 19 billion, which was up 50% from 12.5 billion in 2020. And it's continued to grow from there. They just reported third quarter earnings about a week ago, and those were EPS up 33% and sales up, comp store sales up 5%. And the stock it had momentum going into that, and it's continued to climb after earnings. Let me see exactly how much it is up year to date. It is up. Oh yeah, it's really taken off. It's up 13% year to date, but since earnings jumped from 120 to 131 a share, it gapped up, and it's really been on a tear. It had a rough first half of the year and has been sort of stair-stepping higher since June. And the shares are still relatively cheap, especially considering that, you know, their earnings continue to grow and grew this last quarter. As of right now, the price to earnings ratio is about 24 on a forward basis. Not too bad, not overly expensive, but not dirt cheap. But it's got momentum, and that's something that's hard to find in the retail space right now, especially among, you know, the kinds of brick and mortar stores you might go to this weekend. And you know, these are the types of stores that tend to do well in the holiday quarter. You know, the analysts are calling for, let's see, 10.2% sales growth in the current quarter. So that would be twice as much as this last quarter. So things looking up for the stock after a rough 2020, early 2021. So Ross Stores, ROST, that's my first pick.
Yeah, and that's solid if consumers if we do end up hitting a recession next year, or if people start paring back spending. You know, we've talked a lot about rising consumer debt levels, whether people are going to continue to have that sort of spend momentum that has buoyed the economy for so long. All right, I'm going to go sort of contrary to your momentum play with my next one. I was listening to a podcast, Plain English, I believe is one that you will periodically listen to as well.
Yeah, Derek Thompson. Yep.
Yeah, they had a guest on that was the whole premise was like, we focus so much on the new thing, and we should really, what about the things that never change? Right.
Yep.
Like he shared an anecdote of Warren Buffett driving with another investor and saying, hey, in the 60s, you know what the number one selling candy bar was? Well, it was Snickers. Do you know what the number one selling candy bar is today? It's Snickers.
Yep.
Right. Like some of these things are fixtures for us. So my second pick is Hasbro. That is the toy manufacturing company behind Nerf, Play-Doh. They also own Magic the Gathering collectible card game, Dungeons and Dragons. I mean, these are brands that have been around for 50 years, right? We give my dad a hard time periodically for playing Dungeons and Dragons, probably one time when he was in high school or college. My family has played it a couple of times. We watched the movie, right? These are enduring brands. Hasbro has lost 56% of its share price in the last 5 years, but it's offering a 6.1% dividend yield. It offers those enduring brands. It's still a buy rated stock by analysts and is offering about a 30% upside to the consensus analyst price target. And as of right now, it's trading at 45.75 in the sort of depths of the pandemic bear market in March of 2020. It was trading at 46. So it's trading at a significant discount. Now they have guided for weak sales looking forward, but in the event that the consumer sort of sticks around, we've seen a lot of these toys for adults, these collectibles. I'm sure you've seen the Funko trend and how this is sort of becoming more popular, the nostalgia play. I think the enduring value of the brands with a little bit of a dividend yield for the company to shore up its balance sheet, start trading higher, and pick up some steam when the economy goes into and then comes out of a recession next year. So it's probably more of a watch list stock right now. But if you're interested in undervalued plays, this is one that'll pay you 6% to buy it and hold it and sort of wait for the company to get on more stable footing. And it's trading at a discount. Now, no PE right now because of some earnings losses, but it's a potential value play.
What's that ticker symbol again, Hasbro?
HAS.
HAS. There you go. Okay, good pick. All right, my number 2 is called Restaurant Brands. QSR is the ticker symbol. The Restaurant Brands International is the full name. They own Burger King, Popeyes, Tim Hortons, and something called Firehouse Subs. You have a Firehouse Subs out where you are? I've never heard of it.
Firehouse Subs is solid. They donate
Really?
they donate to fire department charities, first responders. You can go, actually, speaking of Thanksgiving, you can go in, they get pickles in like 5-gallon buckets. You can go in and for a couple of bucks, you buy the used bucket. Great place to brine your turkey.
Nice. Well, that's fitting then. So it's, fast food places were an area that didn't take as big a hit during the pandemic because, just drive up to the drive-through and, wear your mask and it was all good. But while it dipped a little in 2020, rebounded to a new record, $5.73 billion set in sales in 2021, up another 13% to $6.5 billion last year, and is on track for about $7 billion this year, or a little over $7 billion. EPS is trending well, projected to be up about just under 10% this year. And the upcoming quarter, up a few pennies. As for the stock, it is trading at just under 15 times earnings, about 14 times earnings. And the shares are up this year 9%, just under 9%, but have been trending really well in the last month, up, let's see, from 62 to 70 since the middle of October. Just practically think about, so Brad, you and I both have kids. When we're doing holiday shopping, if we're doing holiday shopping out and about rather than from the comfort of our couch, you have a car full of kids, you're not stopping at some fancy restaurant. You're on the move, you're stopping usually at places that maybe you might not normally stop, fast food, or maybe you do normally stop, and Burger King and Popeyes might fall into that. Maybe you're popping in a Tim Hortons, especially if you're in Canada, and getting a coffee. But these are the types of stocks that tend to do a lot of business over the holidays. And QSR, I chose that over something like McDonald's, which does have momentum too, was up slightly last year to date and isn't as cheap on a price to earnings ratio. And also QSR pays a 3.1% dividend yield, so that helps too. So that's my second pick.
Yeah, we'll be eating takeout, fast food, something like that tonight because my fridge is full and I don't want to worry about cooking dinner the day before. I got to spend all day cooking.
Right.
So
there you go. Yeah.
definitely a reasonable play as well for people that are maybe more value conscious when it comes to, or for consumers that are more value conscious when it comes to where to spend their limited budgets if they're spending big over the holidays.
Yep.
My last one is, I don't know if it's the exact opposite of that, but it's probably as far away as you can get from it. It's Louis Vuitton Moet Hennessy
Yep.
LVMUY. The reason that is on my Black Friday list is uh, LVMH owns Tiffany and Co. and it owns Sephora amongst all their other even higher priced brands. This one is maybe more of a bull market stock because obviously consumers are more comfortable spending when they feel like the economy is stronger, and that typically aligns with when the market is doing really well. But it's also the best looking chart out of any of my picks. It's up 164.5%, give or take, in the last 5 years. It's been trending strong that whole time, higher lows, higher highs. Let's see. Part of the reason is, I've got my Nerf, I've got my D&D. I needed something for my daughter, and a little Sephora spend seemed to align. I was looking at Tiffany. No Black Friday deals from Tiffany, and their prices seem to have doubled since the last time I bought anything there. But even still, LVMH, if we've got a market recovery, if there's no recession in sight, I think people are going to continue spending, and they'll spend on luxury goods rather than just accumulating stuff. It's sort of in line with that, with the travel and experience spend. If you're feeling good about the economy but not great, maybe you get a new TV. If you're feeling great about the economy, maybe you splurge on a Louis Vuitton bag.
Okay, good pick. And I know that used to be a favorite, I believe, of Carl Delfeld, who runs our Cabot Explorer
Yeah.
investment newsletter. I think he off and on has had it in there. Maybe it'll
Yeah.
be soon.
One of Carl's key takeaways is that with an expanding global middle class, right, as the global economy does
Yeah.
better for, say, consumers in places like China, India, Vietnam, the what ASEA, the Southeast Asian
Yeah,
communities,
I don't know how you pronounce it, but yeah, yes, that.
that they're spending on the same kind of luxury goods that our consumers are spending on. So there's also definitely an international play there.
Okay, good pick. So my third and final pick, Amazon. What are we doing here? Let's not overthink it. Amazon, you mentioned Warren, that anecdote about Warren Buffett and Snickers. Well, Amazon is sort of becoming the Snickers of, shopping in general.
Yeah.
Online shopping, certainly, but basically just shopping. There's been other times when Amazon has probably been overcooked coming into this time of year. Yeah, but this time, well, it is up 75% year to date at 146 a share. It's well below its July 2021 peak of 180, just under 186 a share. And it was as high as 183, 184 at end of 2021. Had a rough 2022, like most stocks. So we know that the mega caps, especially had a tough year last year, but they have, one of the stories of the year, as we talked about a lot, the Magnificent Seven, of which Amazon is one, have led the charge in the market returning to bull status. Had a great first half of the year, took a dip for a few months, like all stocks pretty much, and now is back with a vengeance. The last month up from 119 to 146. It's currently at 52-week highs. So plenty of momentum, but also plenty of upside considering how much it trades below its 2021 peak. This is just a company that's no one's going to change their habits of shopping on Amazon. And while it doesn't necessarily, looking at its history, at least especially the last couple of years, it doesn't necessarily get a Black Friday bump, at least in the stock price. That might already be baked in. It seems like it tends to streak up until about the week of Black Friday, then takes a bit of a dip. But this is a long-term stock. This is not one you're buying if you don't already own it, which many do. This is a stock you're not just buying for a couple months to squeeze a quick profit out of. This is a stock you're owning for the long haul. A year ago, so it's tracking towards a very good quarter. A year ago, amid sort of its struggles, EPS was just 3 cents. Its average estimate among analysts for the fourth quarter this year is 77 cents. So that's quite an improvement. Sales growth, 11% projected for this quarter, and 11% for the year also, as my daughter joins us in the middle of the podcast, just expressed her Thanksgiving cheer. But yeah, Amazon, that's my third pick.
I think that's it's a good one. One thing you wrote about the Black Friday stocks, the ones that perform best tend to have momentum coming into the fourth quarter. So
yeah, as a first, we knew we'd have some special guests on this Thanksgiving edition of the podcast. I think my dog's in here now too. So those are our three. Okay, let's run down. Actually, you had four technically. I had Amazon, AMZN, QSR, Restaurant Brands International, and I had Ross Stores, ROST. Yours, Hasbro?
Hasbro,
I'll let you
HAS.
do. Yeah.
Samsung, which you can't buy directly. So EWY, 24% stake, or owns 24% of the fund is Samsung. EEM, 4% is Samsung. And then I also had LVMH, which the ticker symbol for Louis Vuitton, Moet Hennessy is LVMUY. That's a little bit thinner traded, but again, out of any of my picks, that one definitely has the best looking chart.
Okay. Before we go, we should be remiss if we didn't talk about the market. I mean, granted, we did a deep dive on it with Mike Santolo and Jacob Mintz, our growth and options gurus here at Cabot last Friday. If you missed that podcast, I highly recommend it. We had a really good sort of robust discussion about how far the market's come in the last 3 weeks and where it could be going. Still looks encouraging. So up 8.5% in the last, or 8-ish% this month. You tend to be a little bit more on the, I don't want to call you a bear, but I tend to be a little bit more conservative in your optimism, I guess, about the market. Where would you be a buyer at these levels, or are you waiting for a pullback?
I'm not necessarily waiting for a pullback right now. The S&P is still holding above some of the technical levels that I was looking for signs of a breakout, which was namely getting above the like that 4,400 level, and it gapped up and went high and went pretty high above there. Maybe bumping its head against the July highs. We'll sort of see. The thing I would be on the lookout for is just not a ton of trading volume in the end of the year, right? I think part of the reason we get some seasonality is that a lot of the big investors are more focused on pairing losers and then showing that they own winners. So the things with momentum tend to keep it. I don't love the Magnificent Seven. It's the most crowded hedge fund trade, I think, in history right now. I was looking at some analysis from Goldman Sachs, which showed a ton of hedge fund crowding in the Magnificent Seven. They just look overpriced to me. But I mean, that's like what Nvidia fell 3.5% or 3.4% today after reporting last night, right? Yeah. And they reported a blowout quarter. It was the kind of quarter that should have maybe propelled the shares higher, but I think that there's just maybe a lack of money chasing these at this point. Everybody's already got them. I don't necessarily even think that's going to be a boon for some of the other stocks. I do think we'll just see sort of an exhale at the end of the year. So some flat, sort of indeterminate direction trade as people jostle for position to get their portfolios looking good heading into next year. So I'm not super bullish through the end of the year, but S&P is holding its technical levels. I think you can definitely be a holder here, if nothing else.
Yeah. I mean, I think what I mentioned on last week's podcast, it was the S&P equal weight index, which is what I've been looking at, and sort of more of a true litmus test of where the market is. I was looking at the 5,900 level, and it was sort of right on the cusp of that last week. Well, now it's up to 5,943, so just kind of what I wanted to see. So I'm encouraged. I think waiting for dips at least is a good strategy here, given how much it's run up this month already, but I'm bullish on the next, at least through the end of the year. And I think we're going to go higher from here.
I mean, we could definitely even just see maybe some normalization where the mega caps drift lower and everything else sort of meets it, and then we get to something that is closer to fair value. But no crystal ball over here.
No. Okay, well, safe. Well, neither of us are traveling for Thanksgiving, so that's a relief at least. But good luck in your basting and your roasting and everything. What do you have in addition to your turkey?
We do mashed potatoes, sweet potatoes. I do like ham hock green beans, pies, rolls.
Yep.
Nothing.
We're almost the exact same.
Yeah, nothing phenomenal. I've got a daily running tomorrow on Thanksgiving proper that talks about the companies that are behind the meal that's going to be on your table. Here's a sneak preview. None of them are phenomenal. They're sort of low profile ish consumer staples companies that they're muddling along, but some of them are at least paying you to hold on to them. But be on the lookout, I guess. If you're subscribed to the daily email, you'll see a little bit more about your Thanksgiving meal tomorrow.
Yeah, that was very creatively done article. I liked it. I highly recommend it. Guys, you want to help me sign off and say goodbye, or no? Okay, my kids are literally at my feet here, all around me. I think one of them is. Yeah, it's a very special edition of Street Check indeed. Well, please, if not for our sake, then for these adorable faces here, please subscribe. Give us a 5-star rating.
For just $5 a day, you can feed a child.
I know.
You can boost the social media profile of a 7-year-old.
Right. Yeah, exactly.
Happy Thanksgiving.
Happy Thanksgiving. Enjoy, and we will be back at our normal day next week.